Assalamualaikum and hi. We are here to present about ratio analysis that representing Petron, Hibiscus Petroleum, Dayang Enterprise Holdings Berhad, Karimin Petroleum Berhad, and Gas Malaysia Berhad. We are here with a shared goal that is to provide insightful financial ratio analysis that highlights performance, efficiency, and financial health across the energy sector. Introducing our team members that consist Abdul Wasi, Nurul Fahana, Wirda Alia, Zulkifli, and me, myself, Nur Fatiha. In these slides, we will talk about introduction, company of each background, trend and comparative analysis, and conclusion. In these slides, we will talk about introduction, company of each background, trend and comparative analysis.
Hi, Assalamualaikum. My name is Abdul Wasi. I will start with introduction from our group assignment. The oil and gas industry is vital to global and national economies, driving energy supply, industrial growth, and innovation. In Malaysia, it remains a key economic pillar despite challenges like price volatility and the energy transition. This presentation analyzes 5 major Malaysian oil and gas companies: Petron, Hibiscus Petroleum, Dayang Enterprise Holdings Berhad, Karimin Petroleum Berhad, and Gas Malaysia Berhad, which operates across the sector's value chain. Using financial ratio analysis, we assess their liquidity, profitability, efficiency, and solvency to understand their financial health and industry performance. Petron Malaysia Refining and Marketing Berhad (PMRMB) is a prominent entity in Malaysian downstream oil and gas sector. Established in April 2012 after acquiring ExxonMobil's downstream business, is Malaysia's third largest downstream player. The Petron Malaysia Group includes PMRMB listed on Bursa Malaysia and its sister company Petron Fuel International Sdn Berhad and Petron Oil Malaysia Sdn Berhad. PRMB visions updated in 2024 aims for a sustainable energy secure nation where everyone's journey is fueled by opportunities for meaningful experience, reflecting a commitment to sustainability. Its mission focuses on setting customer expectation, fostering partnerships, cultivating an entrepreneurial culture, upholding integrity, adhering to safety standards, and promoting stakeholder interests. Core values are excellence, customer focus, innovation, teamwork, ethics, and safety. RMB has over 800 retail service stations nationwide as of 2024 and 11 terminals. Product brands include Blaze Fuels, Turbo Diesel, Euro 5, Diesel Max, and Gasol LPG. Value creation involves ensuring sustainable fuel supply, operational excellence, and enhancing customer experience through trips, convenience stores, and the Petron Miles loyalty program. Strategic moves include retail network expansion and diversification into non-fuel businesses like EV charging station, aiming to broaden revenue and build resilience.
Hibiscus Petroleum Berhad. Hibiscus Petroleum is Malaysia's first listed independent oil and gas exploration and production company. It was founded in 2007 and got listed on the main market of Bursa Malaysia in 2011. Their key activities are focused on monetizing producing oil fields and growing their portfolio of development and producing assets in areas of our geographical focus: Malaysia, Vietnam, Brunei, countries in Asia Pacific, the United Kingdom, and Australia. As an operator of offshore oil and gas producing fields, their efforts are focused on safely enhancing value from the assets in which they have economic interest. Their growth strategy in the current oil and gas market is to leverage opportunities that are present within their portfolio of existing assets and make quality acquisitions on a selective basis, thus delivering sustainable returns to their shareholders. They are committed towards upholding high standards of safety and environmental management. They also prioritize corporate governance and transparency whilst expanding their business on strong technical and commercial foundations. Hibiscus Petroleum is headquartered in Kuala Lumpur, and their securities are listed on the main market of Bursa Malaysia Securities Berhad. Hibiscus Petroleum is a constituent on the FTSE4Good Bursa Malaysia Index as well as the FTSE4Good Bursa Malaysia Shariah Index. Hibiscus Petroleum Securities have been classified as being Sharia compliant by the Sharia Advisory Council of the Security Commission Malaysia.
Assalamualaikum and hi, I am Nurul Fahana binti Ismail. I would like to represent Dayang Enterprise Holding Berhad. Dayang Enterprise Holding Berhad is a leading Malaysian company in the upstream oil and gas services sector. Founded in 2006 and based in Miri, Sarawak, it is listed on the main market of Bursa Malaysia. The company is known for its reliable offshore services essential to petroleum exploration and production. Dayang's core operation include offshore topside structure maintenance, hookup and commissioning (HUC), and marine chartering. These services ensure platform safety, connect new platform for production, and support offshore transport through its subsidiary Perdana Petroleum Berhad. The company has secured a long-term contract with major clients such as Petronas Carigali, Shell, and ExxonMobil. It is recognized for high vessel utilization and strong execution in complex environment. Despite all market fluctuation, Dayang remained resilient by focusing on essential maintenance services that remain in demand. In conclusion, Dayang plays a vital role in supporting Malaysia petroleum sector. Its proven expertise and strong partnership make it a key contributor to the industry, safety, efficiency, and long-term growth.
So I will continue with the Charimin introduction. So in short, Charimin is an integrated oil and gas services provider specializing in pre-construction engineering, integrated maintenance, rejuvenation, hookup and commissioning (HUC), and engineering, procurement, construction and commissioning (EPCC) projects. Charimin also provides marine vessel services utilizing work barges, accommodation ships, fast crew boats, and anchor handling tug supply (AHTS) ships like the Charimin Iris and Charimin Acacia. They hold a Petronas license for products and services, marine vessels, and underwater inspection services. Additionally, they have a civil construction division for general contracting and trading of geotechnical engineering products.
Assalamualaikum and hi, my name is Nur Fatih Hussein and I will be presenting about company Gas Malaysia Berhad. Gas Malaysia Berhad was established on 16 May 1992 with the primary objective of supplying natural gas to customers across peninsular Malaysia. The company operates under the regulatory framework of the Gas Supply Act 1993 and plays a vital role in Malaysia's energy infrastructure. Headquartered in Shah Alam, Selangor, Gas Malaysia has built and maintained a pipeline network over 2,900 kilometers, making it the key player in the distribution of regulated natural gas in the region. In addition to natural gas, the company also supplies liquefied petroleum gas through a pipeline system and is actively expanding into energy-related services such as combined heat and power system, compressed natural gas, and biomethane. This initiative reflects its commitment to cleaner and more efficient energy solutions. Gas Malaysia Berhad was listed on the main market of Bursa Malaysia in 2012, marking a significant milestone in its growth. Since then, the company has continued to strengthen its position as a reliable and innovative energy provider in Malaysia.
Liquidity ratio are vital financial metrics that evaluate a firm's capacity to fulfill its short-term financial commitments. They examine how effective a company can settle current debts using readily available assets. Typically, a higher ratio indicates stronger liquidity and less reliance on external financing, suggesting a more robust short-term financial health. We'll focus on two primary liquidity ratios, the current ratio and the quick ratio. Current ratio. This measures a company's ability to pay short-term liabilities using all current assets, including cash, receivables, and inventories. The formula is current ratio equals to current asset divided by current liabilities. Petron's current ratio, a key indicator of short-term liquidity, showed an improvement from 1.10 in 2022 to 1.28 in 2023, indicating an increased ability to cover its short-term liabilities. In 2024, the ratio slightly decreased to 1.24 but remained above 2022 level, suggesting a generally stable and healthy position in meeting its immediate financial obligations over the 3-year period. Let's see the current ratio for Hibiscus Petroleum. Hibiscus showed a notable improvement in its current ratio from 0.9 in 2022 to 1.49 in 2023, reflecting stronger short-term liquidity. The initial low ratio indicated potential difficulty in covering short-term obligations. However, the sharp increase in 2022 suggested better working capital management, likely through increased current assets or reduced liabilities. In 2024, the ratio held steady at 1.48, maintaining the improved liquidity position. Overall, the company demonstrated positive progress and greater financial stability over a 3-year period. From 2022 to 2024, Dayang's current ratio improved from 2.29 times to 2.60 times, driven by steady growth in current assets outpacing liabilities. This indicates the company's short-term financial strength is solidifying, with ample resources to cover its obligations more than twice over. The upward trend reflects prudent working capital management, possibly due to higher receivables, stronger cash positions, or inventory efficiency. Such a ratio also enhances stakeholder confidence, especially for end creditors assessing liquidity risk. Overall, Dayang demonstrates resilience and improving financial health. Charimin Petroleum Berhad's current ratio started at 2.12 times in 2022 and it increased to 2.39 times in 2023, demonstrating a higher ratio, reflecting the ability to pay its short-term obligations on time. However, this positive trend changed in 2024 as the ratio dropped to 1.97 times, indicating a minor reduction in its capacity to meet short-term obligations with its liquid assets relative to the prior year, even though it continues to stay above the typically generally standard of 1.0. Gas Malaysia Berhad current ratio remained below 1 throughout 2022 to 2024, indicating that its current liabilities consistently exceeded its current assets. This suggests potential short-term liquidity challenges, meaning the company may face difficulty meeting its short-term obligations with its existing current assets. However, the slight improvement from 0.89 times in 2023 to 0.95 times in 2024 shows a positive trend towards better liquidity management. Let's examine the current ratio trends for each company. From the observation and interpretation, we can see that Dayang and Charimin have strong liquidity positions. Dayang consistently demonstrates the strongest current ratio among the 5 companies, peaking at 2.6 in fiscal year 2024. A ratio consistently above 2 indicates a very healthy short-term financial position, suggesting ample current assets to cover current liabilities. This might imply efficient working capital management or a business model with stable revenue streams. Charmin also shows robust current ratios, hovering over 2.0 in fiscal year 2022 and fiscal year 2023, though it dips slightly to 1.97 in fiscal year 2024. While still indicating good liquidity, the slight decline warrants attention, potentially due to increased short-term debt or a reduction in current assets. Secondly, Petron and Hibiscus, they show improving but moderate liquidity. Petron shows gradual improvement in its current ratio from 1.1 in fiscal year 2022 to 1.28 in fiscal year 2023, before a slight dip to 1.24 in fiscal year 2024. Ratios around 1.1 to 1.3 are generally considered acceptable, indicating that the company can cover its short-term obligations but with less buffer compared to Dayang or Charimin. Hibiscus exhibits a significant improvement, almost doubling its current ratio from a concerning 0.9 in fiscal year 2022 to 1.49 in fiscal year 2023, maintaining at 1.48 in fiscal year 2024. The initial ratio below 1.0 in 2022 suggests potential short-term solvency issues, but the subsequent improvement is a positive sign, reflecting efforts to strengthen its current asset base or current liabilities reducing. Gas Malaysia Berhad persistently liquidity concern. Gas consistently maintains the lowest current ratio, staying below 1.0 across all 3 years, 0.91, 0.89, and 0.95. A current ratio below 1 indicate that a company's current liabilities exceed its current assets, which can signal potential difficulties in meeting short-term obligations without resorting to external financing or liquidating long-term assets. This consistently low ratio suggests inherent challenges in its working capital management or a business model that very tight operating cycles. Quick ratio or acid test ratio. This is a more stringent measure assessing a company's ability to meet its short-term obligations using its most liquid assets, explicitly excluding inventory. The rationale for excluding inventory is its potential illiquidity in a distressed scenario. The formula is quick ratio equals to current assets minus inventories and divide by current liabilities. Petron's quick ratio, a key measure of immediate liquidity excluding inventories, showed an improvement from 0.64 in 2022 to 0.76 in 2023, reflecting stronger short-term financial flexibility. However, in 2024, the ratio declined to 0.60, largely due to a significant increase in inventories. Despite this drop, the ratio still indicates a moderate ability to meet short-term obligations with more liquid assets over the 3-year period. Next up is the quick ratio for Hibiscus Petroleum. Hibiscus's quick ratio improved significantly over 3 years, indicating stronger short-term liquidity after excluding inventories. In 2022, the ratio was 0.81, suggesting that the company lacked sufficient liquid assets to cover its current liabilities without relying on inventory, raising concern about immediate solvency. By 2023, the quick ratio rose to 1.35, showed a marked improvement in liquidity and suggesting better asset efficiency or reduced reliance on inventory. In 2024, it held steady at 1.36, maintaining a healthy level. This upward trend reflects improved financial health and a stronger ability to meet short-term obligations using more liquid resources. Dayang's quick ratio shows a healthy and improving position, rising from 2.27 times in 2022 to 0.59 times in 2024. This means the company can comfortably meet its short-term liabilities without relying on inventory sales. The upward trend reflects strong control over liquid assets and stable liability management, a sign of excellent short-term financial discipline and a low liquidity risk. For Charimin Petroleum Berhad, they exhibited a trend comparable to its current ratio. It rose from 2.03 times in 2022 to 2.23 times in 2023 before dropping to 1.63 times in 2024. Gas Malaysia Berhad's quick ratio remained below 1 from 2022 to 2024, indicating that its most liquid assets are not sufficient to cover current liabilities. This points to potential short-term liquidity risk as the company may struggle to meet immediate obligations without relying on inventory sales. Now let's turn our attention to the quick ratio, which provides a more conservative view of immediate liquidity by excluding inventory. From the observation and interpretation, we can see that firstly, Dayang exceptional immediate liquidity. Dayang once again stands out, showcasing remarkably high quick ratios, consistently above 2.0 and peaking at 2.59 in fiscal 2024. This indicates that Dayang possesses a substantial amount of highly liquid assets to to cover its immediate liabilities. Such a strong quick ratio suggests excellent cash management and a low reliance on inventory sales to meet short-term obligations, make it highly resilient to sudden liquidity shocks. Second, the Charmin company shows strong but declining immediate liquidity. Charmin started with a strong quick ratio of 2.03 in fiscal year 2022, improving slightly to 2.23 in fiscal year 2023, but then experiences a noticeable drop to 1.63 in fiscal year 2024. While a ratio of 1.63 is still generally good, the decline suggests that the company might be holding more inventory relative to its quick assets, or there could be a reduction in its most liquid assets. This trend mirrors its current ratio, indicating a potential shift in its current asset composition or increased immediate obligations. Next, the Hibiscus company. They show significant improvement in immediate liquidity. Hibiscus demonstrates the most dramatic positive change in its quick ratio, surging from a very low 0.64 in fiscal year 2022 to an impressive 1.35 in fiscal year 2023 and maintaining at 1.36 in fiscal year 2024. This significant improvement is commendable. A quick ratio below 1.0 indicates a reliance on inventory to cover short-term liabilities, which was the case for Hibiscus in fiscal year 2022. The subsequent increase above 1.0 signifies that the company now has sufficient liquid assets to meet its immediate obligations, reflecting effective measures to improve its very short-term solvency. Next up is Petron and Gas Malaysia. They show persistent immediate liquidity challenges. Petron exhibits a declining quick ratio from 0.81 in fiscal 2022 to 0.6 in fiscal 2024. This trend, especially when compared to its current ratio, suggests an increasing reliance on inventory to meet short-term obligations. A quick ratio below 1 indicates that without selling inventory, Petron might face challenges in covering its immediate debts. Gas Malaysia consistently show the weakest quick ratio, ranging from 0.58 to 0.69 across the years. Similar to its current ratio, this points to persistent and significant immediate liquidity concerns. Companies with such low quick ratio often need to closely monitor their cash flows and working capital to avoid potential solvency crises.
Next, we move into the leverage ratio. It means a financial measure that shows how much a company relies on debt to finance its operations compared to equity or assets. It helps evaluate the company's financial stability and risk level. One of the key types is the debt-to-equity ratio, which compares total liabilities to shareholders' equity. A high ratio suggests heavy reliance on debt, increasing financial risk, while a low ratio indicates a more conservative capital structure. This is a slide of debt-to-equity for Petron company. The ratio shows a declining trend from 2022 to 2023, dropping from 1.15 to 0.94, indicating reduced reliance on debt. In 2024, the ratio slightly increased to 0.97 but still remained lower than in 2022. Overall, this suggests the company is maintaining a more balanced capital structure and managing its financial leverage more conservative over time. Next, we move to the next slide, which is for Hibiscus Petroleum Berhad. It shows that it remained low from year 2022 to 2024, indicating conservative use of debt in its capital structure. Although there was a slight increase from 0.25 in 2022 to 0.32 in year 2023, it dropped to 0.24 in year 2024, showing improved debt management. Overall, the company appears to be financially stable with a strong reliance on equity financing and low financial risk. For Dayang Enterprise debt to equity ratio has significantly decreased from 10.76 in year 2022 to 0.33 in year 2023 and further to 0.27 in year 2024, indicating a strong reduction in reliance on debt financing. This suggests improved financial stability and lower financial risks, as the company is increasingly funding its operation through equity rather than debt. For Karimin, their debt-to-equity ratio decreased from 0.68 in year 2022 to 0.42 in year 2023, indicating reduced reliance on debt, but then slightly increased to 0.52 in year 2024. Overall, the ratio remains moderate, suggesting the company maintains a balanced approach to financing with a mix of debt and equity, managing its financial risks prudently. And lastly, for Gas Malaysia Berhad, their ratio remained relatively stable, fluctuating slightly around 1.4 from year 2022 to year 2024. This indicates a consistent reliance on debt financing that is higher than equity, suggesting the company maintains a leveraged capital structure with moderate financial risk. In year 2022, several companies displayed moderate to high debt levels. Dayang Enterprise stood out with an exceptionally high debt-to-equity ratio of 10.76, heavily influencing the overall leverage in the group. Petron and Gas Malaysia also had relatively high ratios at 1.15 and 1.4 respectively. On the other hand, Hibiscus 0.25 and Karimin 0.68 maintained more conservative positions. By 2023, most companies show significant improvement. Dayang dramatically reduced its debt-to-equity ratio to 0.33, Petron lowered its ratio to 0.94, and Karimin dropped to 0.42. Hibiscus saw a slight increase to 0.32 but remained low overall. Gas Malaysia's ratio remains stable at 1.4, indicating a continued reliance on debt. In 2024, the trend of improved financial discipline largely continued. Dayang's debt-to-equity ratio decreased further to 0.27 and Hibiscus improved to 0.24. Petron's ratio saw a slight uptick to 0.97, while Karimin rose modestly to 0.52, while for Gas Malaysia's ratio stayed around 1.4, consistent with previous years. Overall, the consolidated debt-to-equity trend across these companies suggests a collective move toward reduced reliance on debt and increased financial stability. While some companies continue to operate with higher leverage, particularly Gas Malaysia, the group as a whole has shown prudent capital management over the 3 years period. This reflects a healthier, more resilient industry outlook with lower financial risks. Another point of leverage ratio is times interest earned, TIE, which measures a company's ability to pay interest on its debt. It is calculated by dividing earnings before interest and taxes by interest expense. A higher TIE means the company is more capable of meeting its interest obligations, showing better financial health. This is the time interest earned by Petron. In 2022, the times interest earned ratio was strong at 25.17, showing excellent ability to cover interest expenses. In 2023, it dropped significantly to 9.21, indicating reduced but still sufficient coverage. By 2024, it fell further to 1.53, signaling a much weaker ability to meet interest payments and increasing financial risks. Next is Hibiscus Petroleum. In year 2022, the time interest earned ratio was 35.57, showing strong coverage of interest expenses. It slightly improved to 36.06 in year 2023, maintaining a solid position. However, in 2024, it decreased to 23.08, still healthy but indicating a moderate decline in the company's ability to cover interest payments. For Dayang Enterprise, it shows a significant improvement over the 3 years, rising from 7.65 in year 2022 to 10.21 in year 2023, and sharply increasing to 48.71 in year 2024. This trend indicates a growing ability to cover interest expenses, reflecting stronger financial stability each year. Keramin's time interest earned ratio went from 5.02 in year 2022 to 10.3 in year 2023 and jumped to 31.34 in year 2024, showing better ability to pay interest each year. And lastly, for Gas Malaysia Berhad, it showed the ratio drop from 46.11 in year 2022 to 27.1 in year 2023. Then it slightly increased to 29.45 in year 2024, showing a small recovery in interest paying ability. In 2022, most companies demonstrated strong interest coverage. Hibiscus and Gas Malaysia showed particularly high TIE ratios of 35.57 and 46.11 respectively, indicating excellent ability to cover interest costs. Petron's TIE was also strong at 25.17, while Dayang and Keramin had lower but adequate ratios of 7.65 and 5.02. By 2023, Petron's DIE ratio fell sharply to 9.21, reflecting reduced but still acceptable coverage. Hibiscus remained stable with a slight improvement to 36.06. Dayang and Keramin improved their ratios to 10.21 and 10.3 respectively, signaling better interest coverage. Gas Malaysia's ratio decreased to 27.1, indicating some weakening but still solid coverage. In 2024, companies like Dayang and Keramin show significant improvement, reaching 48.71 and 31.34 respectively, which reflect a strong capacity to meet interest expenses. Hibiscus ratio declined to 23.08, still healthy but indicating a moderate drop. Petron's DIE ratio fell dramatically to 1.53, signaling increased financial risks and a much weaker ability to pay interest. Gas Malaysia showed a modest recovery to 29.45. Overall, the consolidated trend suggests most companies have improved or maintained strong interest coverage from year 2022 to year 2024, enhancing their financial stability. However, Petron's significant decline raises concerns about its future debt servicing capacity. This mixed but generally positive consolidated view highlights the sector's varied but mostly sound financial health regarding interest expense coverage.
Okay, now we will go with financial ratio analysis. Specifically, focusing on activity ratios, the ratio are crucial as they measures how efficiently a company uses its asset to generate revenue. They help us evaluate how well the company manages the resources such as inventory, receivable, and total assets. Our first activity ratio is the average collection period. This is a financial metric that measures the average number of days a company takes to collect payments from its credit customers. It helps assess the efficiency of a company's credit and collection policies. The formula for the average collection ratio is account receivable times 360 divide sales. Let's look at Petron's average collection period ratio. In 2022, Petron's average collection period was 6.82 days. In 2023, it slightly decreased to 6.1 days. However, in 2024, it increased to 7.8 days. Overall, Petron's average collection period has shown some fluctuation with a decrease from 2022 to 2023, followed by an increase to 2024, indicating a slightly longer time to collect receivable in the most recent year. Okay, now moving on to Hibiscus Petroleum Berhad. For Hibiscus, the average collection period was 86 days in 2032. It's still a significant improvement in 2023, dropping to 63 days. In 2024, there was a slight increase to 73 days. In summary, Hibiscus Petroleum Berhad let's demonstrate an improvement collection efficiency in 2023, although it saw a moderate increase in collection days in 2024 compared to the previous year. Next, we examine Dayang Enterprise Holdings Berhad. Average collection period in 2022, their collection period was 138.1 days. It slightly increased to 138.9 days in 2023. Then it saw an improvement decreasing to 123.9 days in 2024. In summary, Dayang Enterprise Holdings Berhad experienced a minor increase in its collection period from 2022 to 2023, followed by a noticeable improvement in 2024, indicating better receivable management. Let's analyze Keramin Petroleum Berhad. Keramin's average collection period was 139.95 days in 2022. It showed a slight decrease to 31.28 days in 2023 and further improved to 111.2 days in 2024. In summary, Caribbean Petroleum Berhad consistently improved its average collection period over the 3 years, indicating a positive trend in its credit and collection efficiency. Finally, for the average collection period, we have Gas Malaysia Berhad. Their average collection period was 28.8 days in 2022. It significantly decreased to 29.97 days in 2023. However, it rose again to 35.54 days in 2024. Gas Malaysia Berhad showed a substantial improvement in its collection period in 2023, but saw a moderate increase in the number of days to collect receivables in 2024. This slide provides a consolidated view of the average collection period across all the companies we have reviewed. In 2022, the values were Petron 6.82, Hibiscus 86, Dayang 138.1, Kermin 139.95, and Gas Malaysia 38.82. In 2023, Petron 6.1, Hibiscus 33, Dayang 138.9, Kermin 131.28, and Gas Malaysia 39.97. In 2024, Petron 7.8, Hibiscus 73, Dayang 123.9, Kermin 111.2, and Gas Malaysia 35.54. In summary, the consolidated data showing varying trends. Petron spread increase, Hibiscus saw an improvement, then a slight rise. Dayang improved, Kermin consistently improved, and Gas Malaysia improved significantly, then slightly worse. Now, let's move on to another key activity ratio, total assets turnover. This is a financial ratio that measures how efficiently a company uses its total assets to generate revenue. It shows how many ringgits or dollars of sales are produced for every ringgit or dollars of asset owned. The formula is total asset turnover, which means sales divided with total assets. Here is Petron's total asset turnover ratio in 2022. Petron's total asset turnover was 3.85. It slightly decreased to 3.66 in 2023 and it slightly decreased to 3.4 in 2024. Here we have the total asset turnover for Hibiscus Petroleum Berhad. We can observe their performance over the 3 years. Okay, in 2022, their total asset turnover was 0.31 times. It saw a slight increase in 2023, reaching 0.38 times and continued to improve in 2024, reaching 0.41 times. This outward trend suggests that Hibiscus Petroleum Berhad has been increasingly efficient in utilizing its assets to generate sales over this period. Next, let's examine Dayang Enterprise Holdings Berhad total asset turnover ratio. Okay. Looking at the data, in 2022, the ratio stood at 0.42 times. In 2023, it slightly improved to 0.44 times and show a more significant increase in 2024, reaching 0.4 times, 0.54 times. This consistent growth indicates that the enterprise has been improving its asset utilization, generating more sales from its total asset base year after year. Now, let's turn our attention to Caribbean Petroleum Berhad's total asset turnover ratio. The performance show a ratio of 0.8 times in 2022 and increased to 0.92 times in 2023 and a slight decrease to 0.9 times in 2024. While there was a slight dip in 2024 compared to 2023, Caribbean's total asset turnover remains a relatively strong, indicating a good level of efficiency in converting assets into sales. Finally, let's analyze Gas Malaysia Berhad total asset turnover ratio. Okay, the figures are 2.43 times in 2022, a notable increase to 2.52 times in 2023, followed by a decrease to 2.19 times in 2024. Gas Malaysia shows a higher turnover compared to some others company, but there was a decline in 2024. This could be due to various factors that warrant further investigation to understand their asset management. To summarize our findings on the total asset turnover ratio, this consolidated view allows us to compare the companies directly. Okay, we can see that Petron consistently maintains a very high total asset turnover, indicating exceptional efficiency in utilizing its asset to generate revenue. Despite a slight decline over the years from 3.85 in 2022 to 3.4 in 2024. Hibiscus and Dayang have demonstrated improving trends in the asset turnover from 2022 to 2024 at lower magnitudes, with hibiscus increasing from 0.31 to 0.41 and Dayang from 0.42 to 0.54. Clearly show an initial increase, but then a slight decline in 2034, going from 0.8 in 2022 to 0.90 in 2033. Yes, Malaysia also show strong asset utilization, with a dip in 2034 from 2.43 in 2032 to 2.19 in 2034. This trends highlight varying degrees of asset management efficiency across this company within the industry.
We go to profitability ratio. Profitability refers to a company's ability to generate earnings relative to its revenue, assets, or other financial metrics. It is a key indicator of financial success and long-term sustainability, showing how efficiently a company turns business activities into profit. Two commonly used measures of profitability are operating profit margin (OPM) and return on assets (ROA). Together, OPM and ROA provide a comprehensive view of a firm's financial performance from both operational and asset efficiency perspective, making them essential tools in profitability analysis. Operating profit margin is a financial ratio that measures how efficiently a company generates profit from its core operation before interest and tax. It shows the percentage of revenue remaining after covering operating expenses like salaries, rent, and admin costs. OPM is calculated as operating profit divided by revenue times 100. A higher margin indicates better cost control and stronger operational performance, making it a key indicator of business efficiency. For Petron Malaysia, in 2022, Petron posted an OPM margin of 1.65%, indicating modest efficiency in its core operation relative to total sales. In 2023, the margin rose to 2.03%, showing improvement in operational performance, likely due to better cost management or more favorable refining margins. However, in 2024, the OPM fell sharply to 0.38% despite a slight drop in revenue. This significant decline suggests rising operational costs, lower profit margins, or possible external pressures such as volatile crude oil prices and weakening demand. For Hibiscus Petroleum, in 2022, Hibiscus recorded a strong OPM of 49.21%, showing that nearly half of its revenue was retained as operating profit. This reflects efficient management of production and operating costs. In 2023, the margin improved up to 50.74%, indicating further enhancement in cost control or better pricing strategies. This suggests that the company managed to grow revenue while maintaining strong operational efficiency. In 2024, although the revenue and profit increased in absolute terms, the OPM slightly declined to 49.46%. This minor dip may reflect higher operational costs or changes in market conditions, but overall efficiency remains strong. For Dayang Enterprise Holding Berhad, in 2022, Dayang recorded a healthy OPM margin of 21%, reflecting solid cost control and efficient operation. In 2023, the margin rose significantly to 29.1%, suggesting stronger revenue growth and better optimization of operational resources. By 2024, Dayang achieved an impressive 33%, indicating continued improvement in operational efficiency and profitability from its core services. The steady increase in Dayang's OPM over 3 consecutive years highlights the company's growing strength in managing costs and enhancing productivity. Charimin Petroleum in 2022 recorded a very slim operating margin of 0.02%, indicating that only a tiny portion of its revenue translated into operating profit. In 2023, the margin improved slightly to 0.08%, suggesting better cost control or an increase in operating efficiency. By 2024, the margin rose to 0.12%, reflecting continued but modest progress in operational performance. Although Charimin operating profit margin remains low compared to industry peers, the gradual increase over 3 years signal efforts towards improving cost efficiency and profitability. Sustaining this upward trend will be crucial for strengthening its financial performance in the competitive oil and gas service sector. For Gas Malaysia Berhad, in 2022, Gas Malaysia recorded an OPM of 7.07%, reflecting solid operational performance in a stable demand environment. In 2023, the margin declined to 6.27% despite revenue growth, indicating a rise in operating costs or pressure on margins. In 2024, the margin improved to 7.24%, suggesting enhanced efficiency and better control over operational expenses. Gas Malaysia has maintained a steady OPM around 7% range over the 3 years. The slight dip in 2023, followed by a recovery in 2024, indicates resilience and effective cost management, contributing to sustained OPM. Operational profitability in the utilities and energy distribution sector. Conclude, in 2022, Hibiscus Petroleum stood out as the strongest performer with an impressive OPM of 49.21%, demonstrating its ability to convert almost half of its revenue into profit. This reflects excellent cost management and profitability in its upstream oil exploration and production activities. Coming in second was Dayang, with a margin of 21%, indicating healthy operational efficiency in its offshore maintenance and hookup commissioning services. Gas Malaysia ranked third with 7.07%, showing decent return in its regulated and utility-focused gas distribution segment. Petron followed with a low margin of 1.65%, which is common in the downstream oil sector, where refining costs and fuel price volatility impact profit margins. Charimin placed last with a margin of only 0.02%, suggesting minimal profitability and possibly high operating costs or limited project activity during the year. In 2023, Hibiscus maintained its top position with a slightly higher OPM of 50.74%, continuing its outstanding operational performance. Its consistency reflects a strong strategic focus on high-margin assets and efficient cost control. Dayang improved significantly, reaching 29.10%. Reinforcing its position in second place. This jump signals a recovery or increased project wins that boosted its operating earnings. Gas Malaysia remained in third place with a margin of 6.27%, showing continued stability in its operation. Petron experienced a slight improvement to 2.003%, yet it still faced margin pressure typical of the fuel retail and refining sector. Charimin saw a modest increase to 0.09%, but remained the lowest ranked company, indicating ongoing operational challenges or inefficiencies. In 2024, Hibiscus Petroleum again led the group with an OPM of 49.46%, proving its ability to sustain high profitability over time. Its dominance in this ratio highlights its strong operational model and favorable asset portfolio. Dayang climbed even further to 33%, showing consistent upward momentum and improved project execution. Gas Malaysia slightly recovered to 7.24%, maintaining its third place position, reflecting a resilient and stable cost structure. Surprisingly, Petron saw a sharp decline to just 0.38%, dropping to last place. This substantial fall suggests declining refining margins or increased operational costs that significantly reduce profitability. Charimin, although still with a low OPM at 0.12%, moved up to fourth place due to Petron drop. The slight improvement may reflect marginal gains in efficiency or new project contribution. As conclusion, when viewed across the 3 years, Hibiscus Petroleum consistently held the first place, maintaining the highest OPM by a large margin. Dayang also demonstrated strong upward performance, securing second place each year with continuous improvement. Gas Malaysia remained steady in third place, reflecting consistent operation. Petron started in fourth place but dropped to fifth in 2024 due to declining profitability. Conversely, Charimin, although consistently low, improved slightly and overtook Petron in the final year. This ranking highlights the distinct operational strength and weakness among the companies. Hibiscus and Dayang emerged as top performers with strong profit-generating capabilities, while Gas Malaysia provided stable returns. In contrast, Petron and Charimin show significantly weaker performance with narrow margins that expose their vulnerability to cost pressure and market fluctuation. This evaluation of OPM trends and ranking give valuable insight into each company operational efficiency and cost management within the competitive oil and gas industry. Return on asset (ROA) is a key financial ratio that measures how efficiently a company uses its asset to generate net profit. It reflects the company's ability to convert its total resources such as property, equipment and cash into earnings. A higher ROA indicates better asset utilization and overall operational effectiveness. The ratio is calculated by dividing net profit by total asset and then multiplying the result by 100 to express it as percentage. In formula form, it can be written as ROA equals to net profit divided by total asset times 100. This ratio is especially useful for comparing companies in capital-intensive industries or for evaluating how well management is deploying resources to produce returns. A consistently high ROA signals strong financial discipline, while a low ROA may indicate inefficiency or underutilized asset. For Petrol Malaysia, ROA in 2022 achieved of 6.32%, reflecting efficient use of its asset to generate solid earning. In 2023, the ROA declined slightly to 5.79%, suggesting a minor drop in profitability relative to its asset base. However, in 2024, there was a sharp decrease to just 0.39%, indicating significantly reduced profitability despite a stable asset size. This may be due to lower earning caused by declining margins, external market pressure or higher costs. Petrol Malaysia ROA trend reveals a notable decline in asset efficiency over the 3 years period. While performance was strong in 2022 and 2023, the steep fall in 2024 highlight potential operational or market challenges impacting net returns. Moving forward, improving cost control and revenue generation will be crucial to restoring ROA to healthier level. For Hibiscus Petroleum in 2022, Hibiscus recorded a strong ROA of 11.84%, indicating efficient asset utilization and strong profitability, likely driven by favorable oil prices and solid production output. In 2023, ROA dropped to 6.46%, reflecting a decline in earning performance relative to asset growth, possibly due to increased investment or higher operational costs. In 2024, the ROA slightly recovered to 7.07%, suggesting a modest improvement in profitability and better alignment between asset use and income generation. Hibiscus Petroleum demonstrated a healthy ROA in 2022, followed by temporary dip in 2023. The recovery in 2024 indicates strengthening operational performance and improved earning efficiency. Despite the fluctuation, the company continues to show its capability to generate solid return from its asset base in the upstream oil and gas sector. Dayang Enterprise ROA in 2022 recorded a moderate ROA of 5.3%, indicating reasonable asset efficiency during the post-pandemic recovery period. In 2023, the ROA increased to 9.37%, driven by stronger earning and controlled asset growth, reflecting improved operational performance. In 2024, ROA rose further up to 13.4%, showing a significant enhancement in asset utilization and profitability. This sharp rise indicates successful project execution and strong demand in its core services. Dayang demonstrated consistent growth in ROA from 2022 to 2024. The steady upward trend highlights the company increasing efficiency in using its asset to generate profit, marking strong financial and operational progress in the oil and gas support service sector. Sharimin Petroleum in 2022 achieved a ROA of 0.14%, reflecting modest return relative to its asset base. In 2023, despite an increase in earning, the ROA fell to 0.10%, mainly due to a proportionally larger asset base. In 2024, the ROA declined further to 0.07%, suggesting diminishing efficiency in converting assets into net profit. Sharimin remained low and showed a declining trend over the 3 years period. These point to challenges in asset productivity or profitability. To enhance financial performance, the company may need to focus on increasing net income or better utilizing its asset. Gas Malaysia Berhad ROA across the 3 years is shown in 2022. The company posted a strong ROA of 12.38%, indicating highly efficient use of its asset base to generate profit. In 2023, there was a slight dip to 11.96%, though still reflecting solid asset efficiency with stable earning. By 2024, the ROA rose slightly to 12.01%, supported by increased earning despite asset growth. Gas Malaysia maintained a consistently high ROA across all 3 years, showing strong and stable performance. The near -12% return each year demonstrate effective asset management and profitability in the regulated gas distribution sector. Let's see, in year 2022 ranking, Hibiscus Petroleum led to the group with the highest ROA of 11.84%, highlighting strong earning relative to its asset base, likely due to high margin production asset and control costs. Gas Malaysia came in second with 12.38%, a close contender reflecting efficient operation in a regulated and stable market. Petron followed with 6.32% ROA, indicating moderate efficiency in utilizing its asset for profit. Dayang recorded a lower ROA of 5.30%, possibly due to a lower asset turnover or recovery from earlier project slowdown. Charimin ranked last with a minimal ROA of 0.14%, suggesting it earned very little profit compared to its total asset in that year. In 2023, we can see Dayang Enterprise experienced a strong recovery, rising to the top with an ROA of 9.37%, reflecting increased profitability and more efficient asset usage, likely due to a high service demand or better project margins. Gas Malaysia maintained a competitive position with 11.96%, slightly lower than its previous year but still among the top performers. Hibiscus saw a decline to 6.46%, possibly from asset-based expansion or lower net earning relative to 2022. Petron slipped further to 5.79%, continuing to face asset utilization challenges in the downstream sector. Charimin Petroleum, though still low, improved to 0.10%, showing marginal gains in operational return. In 2022, Dayang Enterprise rose to become the strongest performer with ROA 13.40%, showing efficient growth and strong asset productivity, possibly through continued project expansion or improved operational margins. Gas Malaysia remained consistent at 12.01%, further proving its dependable return profile though steady income generation. Hibiscus stood at 7.07%, slightly up from the previous year, suggesting stable yet lower return as compared to earlier period. Petron dropped significantly to 0.39%, reflecting either sharp profit decline or a disproportionate increase in asset, leading in inefficiency. Charimin saw a minus increase to 0.07%, remaining the weakest in terms of asset profitability. As conclusion, ROA analysis highlight differing strategies and efficiencies among the companies. Dayang and Gas Malaysia emerged as the most efficient in generating profit from their asset base, while Hibiscus maintained moderate performance. Petron and Charimin, however, reveal weak asset utilization, likely due to sectoral pressure, sectoral challenges, or capital intensity. This comparison helps stakeholders assess which companies are better at maximizing return from their investment and operational structure over time.
Okay, so next for the last ratio is the market ratio. So what is market ratio? Market ratio is to evaluate a company's financial performance in relation to its stock market value. These ratios are mainly used by investors to assess a company's attractiveness and valuation in the capital market. Okay, so last but not least, I will continue with the dividend payout ratio. So what is dividend payout ratio? Dividend payout ratio is the percentage of net income a company returns to shareholders in the form of dividends. It reflects how much profit is distributed versus retained for growth or debt repayment. So the formula for dividend payout ratio is dividend per share divide earning per share times 100. Okay, so firstly, for Petron Malaysia's dividend payout ratio rose sharply from 17.94% in 2022 to 24.81% in 2023, then surged to an exceptional 344.27% in 2024. This is unusually high payout ratio in 2024 reflects the company's strong commitment to shareholder returns despite a sharp drop in profitability, likely drawing from retained earning. Okay, so for the second company is Hibiscus Petroleum dividend payout ratio. So this company in 2022, only 6.17% of earnings were distributed as dividends, reflecting a conservative approach. This rose to 12.6% in 2023 and further in 14.6% in 2024, suggesting improved earnings, stability, or confidence in future performance. The upward trend signals a more shareholder-friendly dividend policy while still retaining a majority of earnings for reinvestment and reserve. Next, for Dayang Company, from 2022 to 2024, the company's dividend payout ratio reflects a changing approach to profit distribution. In 2022, 30% of earnings were paid as dividends, indicating a balanced strategy. The ratio dropped to 23.68% in 2023, suggesting the company retained more earnings, likely for reinvestment or financial stability. By 2024, the ratio rose to 37.04%, showing stronger performance and a greater return to shareholders. Overall, the trend highlights the company's adaptability in aligning dividend policy with financial condition and growth priorities. Okay, so next for Carimin Petroleum Berhad, the ratio was 0% in 2022, increased to 0.2% in 2023, and then slightly decreased to 0.19% in 2024. So there was no dividend in 2022 because the most common reason is that the company could be facing financial challenges such as reduced earning or potential losses. Dividends are distributed from a company's retained earnings, so if profits decrease, they might choose to preserve cash. Okay, so for the last company is Gas Malaysia Berhad. So this company's dividend payout ratio increased from 22.9% in 2022 to 28.73% in 2023, indicating a higher proportion of earnings distributed to shareholders as dividends. In 2024, the ratio decreased slightly to 25.35%, reflecting a more balanced approach between rewarding shareholders and retaining earnings for growth. Okay, so as we can see in the graph, Petron with 17.94% and Gas with 22.9% demonstrated steady to strong dedication to returns for shareholders. Hibiscus with 6.17% focused on reinvestment, probably for expansion or to boost its financial status. Dayang had 30% allocated, a larger share which indicates a developed enterprise. Carimin with 0% kept all earnings, which indicated operational requirements or growth plans that were in line with its lower asset efficiency. In 2023, trends started to differ, with Petron at 22.83% and Gas at 28.73%, raised distribution and highlighting their dedication to shareholders. Dayang with 23.68% slightly reduced its payout potentially, moving towards retaining a larger share of earnings. Hibiscus has 12.6%, raised its distribution, which indicate enhanced profitability. Carimin with 0.2% stayed concentrated on maintaining earnings and consistent with its low return on asset. In 2024, it experienced notable changes. Petron's distribution skyrocketed to an incredible 344.27%, showing it disbursed significantly more than its income. This combined with its declining return on asset, heightened worries regarding sustainability or financial trouble. Dayang had 37.04%, maintained its upward line and backed by strong profitability that facilitated higher distributions. Gas with 25.35% experienced a minor decline, whereas Hibiscus with 14.6% maintained its gradual rise and reflected careful yet consistent gains. Carimin with their 0.19% stayed minimal and highlighted ongoing financial difficulties. Overall, year by year, Gas Malaysia has consistently shown a strong and indicating steady profitability. Dayang exhibited a robust upward trend with rising payouts backed by remarkable asset efficiency. Hibiscus displayed a careful but enhancing trend. In contrast, Petron's significant increase in payouts for 2024 indicates possible financial troubles or an unsustainable strategy. Charimin repeatedly displayed low payouts reflecting persistent financial limitations. Okay, so next, price-earning ratio. So price-earning ratio measures how efficiently a company uses its assets to generate net profit. It shows how much profit is earned for each ringgit or dollar of assets owned. Okay, so first, Petron Malaysia's price-earning ratio increased slightly from 4.42 times in 2022 to 4.51 times in 2023, then jumped sharply to 67.61 times in 2024. This big rise was caused by a large drop in earnings per share, while the share price stayed almost the same. It shows that the high price earning in 2024 was due to weak earnings, not stronger investor demand. Okay, next for the Hibiscus Petroleum. In 2022, the ratio was 1.23 times, indicating a relatively low market evaluation of earnings. It increased to 1.74 times in 2023 and sharply to 4 times in 2024, suggesting the market was willing to pay more for each unit of earnings. This rising trend may imply improved market sentiment, stronger growth prospect, or higher demand for the company's share despite modest earning growth. Next for Dayang Company, in 2022, the price-earning ratio was 7.82 times, suggesting moderate investor confidence. In 2023, it rose slightly to 8.46 times, indicating growing optimism about the company's performance. By 2024, the ratio increased further to 12.42 times, showing that investors are willing to pay a higher premium for the company's earnings, possibly due to improved profitability and future growth expectations. Overall, the upward trend indicates increasing market confidence in the company's earning potential. Okay, next, for the price-earning ratio of Charimin Petroleum Berhad, steadily fell from 18.67 times in 2022 to 7.3 times in 2023, and then to 5.14 times in 2024. This is because the higher ratio shows that the company's market price is inflated. The last one is Gas Malaysia Berhad. The company's price-earning ratio declined from 13.67 times in 2022 to 10 times in 2023, suggesting that the market valued the company's earning less in 2023 compared to the previous year. However, the price-earning ratio rebounded to 13.38 times in 2024, indicating renewed investor confidence and a higher valuation of the company's earning. Okay, as we can see in the graph, Charimin had a high price earning of 18.76 times, indicating robust investor expectations even with its low asset efficiency. Gas came in at 13.67 times, indicating strong confidence. Dayang had a moderate valuation at 7.82 times, while Petron at 4.42 and Hibiscus at 1.23 times exhibit the lowest price earning and possibly suggesting undervaluation or market worries for the latter despite its strong return on asset. As of 2023, Charimin's price earning fell considerably to 7.35 times, probably because of ongoing low asset efficiency. Hibiscus experienced a slight rise in price earning to 1.74 times, possibly reflecting its significant decrease in return on asset, yet remains quite low. Dayang price earning rose to 8.46 times, in line with its enhanced return on asset and increasing investor trust. Gas price earning dropped to 10 but still held a strong valuation, whereas Petron stayed steady at 4.51, which indicates ongoing market wariness. And then the most significant change took place in 2024. Petron's price earning ratio surged to an incredible 67.81 times, even with a declining return on asset, suggesting extremely speculative market sentiment or expectation of a major recovery. Dayang maintained its upward momentum, hitting 12.242 times, indicative of its remarkable return on asset, increase and dominance in asset efficiency. Gas stayed robust at 13.38 times, affirming its dependability, and Hibiscus price earning rose further to 4, indicating a steady recovery in confidence. and Charimin price earning declined further to 5.14 times, reinforcing persistently low investor expectation owing to its poor asset efficiency. Overall, year by year, these trends emphasize gas as a steady investor trust and Dayang's remarkable growth. Hibiscus demonstrated a steady price earning rebound even with fluctuating return on asset. Petron's remarkable increase in price earning in 2024 reveals a complicated scenario, a market speculation, and Charimin repeatedly lagged in market valuation. This price earning variation highlight how market value is influenced by present earnings and anticipated future performance. So in conclusion, an analysis of major nation oil and gas firms from 2022 to 2024 shows diverse financial stability. Dayang Enterprise Holdings Berhad excels with strong cash flow, minimal debt and high efficiency, which guarantees substantial profit and instills investor confidence. Hibiscus Petroleum Berhad performs well by effectively managing debt for expansion of assets. Gas Malaysia Berhad upholds steady utility-driven finances with reliable cash flow supporting debt handling. Charimin Petroleum Berhad faces challenges with thin profit margins and weak asset returns, even with some debt enhancement. Petrom Malaysia Refining and Marketing Berhad is experiencing significant distress due to steep decreases in profit and assets, inadequate interest coverage and unsustainable dividends, necessitating immediate strategic measures. Therefore, investors need to carefully assess the performance of each company and underlying factors. That's all from us. Thank you.